7 of Real Estate Real Fast. Thanks so much for joining us. I'm your host, Aaron Jistel. A little bit about me. I'm the broker and one of the co-founders here at ListingSpark. I've been in the real estate business for almost 20 years. I've been fortunate enough to be a part of over 6,000 sales here in the Texas area. And so what we do here at ListingSpark a lot is we work with a lot of investors. We work with a lot of home builders and people that are real estate professionals. So I'm excited to talk real estate today for the average person who's thinking about getting into real estate investing or just interested in real estate in general. You've definitely come to the right place. So I'm super excited for our guest today. We've got Justin Hrabovsky. He's been in the real estate space for as long as me or longer. So in a lot of different facets, whether that's obviously in the lending side now, but you've been in a lot of other home building and some other areas of real estate. So I'm super excited to talk to you. So Justin, why don't you give us a quick rundown about you and your business and kind of your experience in real estate?
Hey, appreciate the intro, Aaron. Yeah, it's always a pleasure to connect with you and work together as we have in past. But for all the listeners and viewers, my name's Justin Hrabovsky. I'm a branch manager, a senior loan officer, mortgage extraordinaire in the residential lending, CMG Financial, also branded CMG Home Loans. We are the nation's largest privately held mortgage company. We have a lot of patented mortgage loans and mortgage solutions that help our clients win in this current environment. Myself, like Aaron mentioned, I've been kind of in the real estate lending world for about 20 years as well. Initially on the real estate individual broker side, spent quite a bit of time in the new home world, actually in the past housing crisis. So a lot of the strategies we're going to connect and talk about are things that I learned and were most beneficial during that time period. But also in the past decade, have been in the residential mortgage lending world. I have a personal team that we help home finance clients on residential real estate, and also a mentor about another dozen loan officers in the branch and help grow their business as well.
Love it. I think one of the interesting things that it's always fun talking to somebody that's been in the business a while, and you just touched on it, is, there's a whole generation of buyers, sellers, investors, everybody that has only operated in this bull run of the real estate market that we've had. And so a lot of people don't know what it looks like to have a downturn or a correction or a recession. And I remember 2008 pretty well. I had been in the business for several years. And so luckily in Austin, we were, pretty well insulated, but we certainly learned a lot. So I think that segues into the perfect first question I had for you, Justin, is how do buyers and sellers kind of start adjusting to a changing market?
Well, for one, it's being cognizant of the change, right? And what I mean by that is, especially here in Central Texas, we've been blessed for, a significant amount of rapid appreciation the last several years. But in combination with that, we kind of had an artificially Fed-induced and pandemic-induced, historically low mortgage rate environment that really increased affordability, but that also helped drive prices and demand up. And so now we're kind of actually getting back into a more normalized market. The average 30-year amortized mortgage rate in the last 40 years is actually 7.7%. So anybody that's kind of experienced the landscape in the last, several years, 5, 8, 10 years, et cetera, is really experiencing an abnormal market when it comes to the mortgage rate environment. So I think a couple of things just to be mindful of is the shift in the market, a little bit of shift in a lot of great opportunity shifting into a buyer's market. And there's a lot of ways that we could prepare and position ourselves to take advantage of this market and be cognizant of different tools and products to help negotiate both on the seller and the listing side. As a seller, it's also to be mindful of we're in a little bit different market than we were 6 months ago. And with the increased amount of inventory homes that's here in Central Texas, right, which about a 10-year high, about since 2012, I believe. We haven't had this number of active listings in our marketplace, but there's a lot of opportunity to be had. And it's just important to understand that the market that we've been in previously is the abnormal market. And I have some slides we'll share a little bit later in this podcast as to showing what history, does repeat itself and what to anticipate during this winter, this year, and also in the next coming years, in both the real estate and the mortgage expectations in our industry.
Yeah. No, I think that's an awesome point. I mean, it's easy to get blinded by what's happened over the last, 18 months and that run up in home values. And I think what we're dealing with a lot right now is, people that are just, they're upset. They feel like they missed their window. They feel like they're, have kind of lost their chance to cash out and get big bucks on their house, or buyers are kicking themselves for not getting in when they could have earlier, or something like that. And I think the reality of it is that real estate for most people happens on a much longer time horizon. And the market's going to go up, it's going to go down, but in the long run, it's inevitable we're going to have corrections here and there. This one was actually pretty long overdue. If you look at, previously we would see a correction every kind of 7 to 9 years. This one lasted, closer to 13, 12 years. So we were a bit overdue, but I think the reality of it is that just people have to continue to understand homes are still going to get bought and sold. There's still going to be people that need to sell, and there's still going to be buyers that need to buy. And right now, people are looking for some good news. They're looking for a way to get an edge or kind of better understand the market. And I think education is a big component of that. So that's a big reason why I wanted to have you on here, is because obviously you've got a lot of insight into what's going on in the lending world. So I think a buzzy topic right now is obviously rates. So a year ago today, rates were about half of what they were right now. So where are we at with rates? What are you seeing? What should people expect when it comes to those?
Yeah. So for the mortgage rate environment, again, like I mentioned, though, we're still below the last 40-year average, right? So we are below 7.7% on an average on a 30-year amortized loan, but we are about double than, the pandemic lows that we kind of seen the rates in the 2s and 3s. That opportunity is definitely long gone. I don't know if we'll personally ever see this in our lifetime again. But rates have been ticking up quite a bit this year, starting in March. We have had the most aggressive federal funds rate hike in history as a percentage year over year. Fed funds rates are not directly correlated to mortgage rates, but they do ultimately follow trends of where interest rates are going to move. Even the 10-year Treasury right now is about 4.15 today. Hasn't been to this extent since 2007. 10-year Treasury and mortgage rates also follow similar trends, not based upon each other. But so we are in this increasing rate environment. So this market does bring opportunities for other mortgage solutions that to get through this time period of a little bit higher interest rate environment with the expectation of a lower rate environment at some point in the near future. And I'll speak to that later in the podcast. But adjustable rate mortgages, there's definitely back again. I know they had a negative connotation post-housing crisis. Most of that connotation was, for one, education, consumers that were taking advantage of this in the last, pre-2008 were less qualified to obtain those mortgages. So there's been a complete overhaul in the mortgage industry when it comes to standards and guidelines to ultimately be a little bit more conservative. But adjustable rate mortgage in the last 5-7 years haven't had any demand in that secondary market because of how low fixed rate mortgages were. So now we're in the last several months, a 5, 7, and 10-year adjustable rate mortgage on a 30-year amortization is becoming a more attractive option to help with affordability. There's a lot of value right now in the 10-6 ARM that we're offering in our organization comparatively. But as a consumer, it's real important to really kind of embrace the concept of marry the house, date the rate, and divorce the rent if you're a first-time buyer. So the market's going to ebb and flow, and it's really taking advantage of buying opportunities or selling opportunities if you're looking to sell and purchase another property, of the reasons why you're actually looking to make that purchase decision, right? If it's a first-time home, of course, you're going to participate in all the aspects that owning real estate provides to you. That's not just financial, but to understand that the market will present another opportunity in a lower rate environment at some point in the near future. Speculative to say when, but other solutions are available in the marketplace to make it more affordable in the current environment, such as adjustable rate mortgages. And the strategy has also shifted to be more in negotiation in the buyer's hands, whether it's negotiation on price or seller concessions to strategize a financing option of permanent buy downs or temporary buy downs. And we've been very successful at helping our clients on both sides, seller side and buyer side, come to agreeable terms that best helps each party achieve their goals. And a lot of this has to do with structuring finance properly in the current market.
Yeah. No, I think that's all good insight. I think one of the big, obviously, ARMs and adjustable rate mortgages got it was almost like a curse word after the housing crisis of '08. I think a big issue back then was some people didn't even know they had an adjustable rate. They walked into a new home builder and they were advertising, get into this house for X amount a month. Which I think is a real dangerous part. Because obviously, when it comes to loans and things like that, you can play around with a lot of different things to get a monthly payment where you want it in the short term. But obviously, if that's on a 2 or 3 year adjustable rate and that kicks in and you don't know what's going on, then that's gonna cause a big issue. And that's what happened from a lot of those loans that were getting written in '04 and '05. Those adjustable rates were kicking in, right around 2007, 2008. And I think now, as long as you know what's going on, you keep an eye out, and you're watching the market, you understand what's happening, and you stay informed, those are perfectly safe opportunities. And you just have to time and watch the market for a good opportunity to refinance down the road. So you mentioned a couple things about buy downs and some other opportunities. So I think that's a great opportunity to just talk about some different loan products that really everybody should know about. I mean, obviously buyers out there should know about these loan products, but what we want to do is we want to do a really good job of educating our sellers. ListingSpark predominantly works with home sellers as a solution to sell their house, kind of in a hybrid structure where they're not getting a traditional agent and paying the same commissions to a listing agent. So what we want to do is we want to be able to educate a lot of our sellers on how should you be offering up concessions or incentives to come to look at your house for a buyer. And different loan products are a great way to do that. So like a seller can offer a credit that can go towards a certain loan product that the buyer can use to buy down the rate. So let's kind of talk about some of those products that are out there.
Yeah, there's a lot of strategies to take advantage of in the current marketplace. I'll change it up a little bit on my side where I'll share a screen, at least to connect about the buy down strategies in tandem of us connecting, and I'll do best as possible to describe what we're visually showing to clients that are listening in here. But temporary buy downs are really a win-win. Especially for the buyer side. So to give an example, in the seller concessions, when it comes to a buyer or a seller incentivizing their property to take advantage of, to make a deal work, there's a few ways to do this. There's price negotiation. There's seller concession, where seller concession can go towards closing costs to reduce the cost for the buyer. Or you can use seller concessions towards, most common paths was a permanent rate buy down, which that means it's permanently going down to buy that interest rate on that loan term. That is money lost, by the way, if a buyer ever refinances. And so if you refinance a loan when rates drop in the future, any monies that were used to lower that interest rate on that loan are lost in the form of a refinance. So that is a strategy, though. But what most common we're having success with right now is a temporary buy down, and the amount of concessions do vary by loan type of how much a seller can concede to the buyer. To give an example, there's really 4 versions of mortgage loans out there right now. You have conventional loans that are most common, most widely accepted and used in the U.S. But they do vary on how much you can concede based on the occupancy. If it's a primary residence or a second home and a buyer puts 10% or greater down, a seller can concede 6% towards seller concession, and that's 6% of the loan amount. And then you also have, of purchase price. If a buyer on a conventional loan puts less than 10%, the seller concession is capped at only 3%. If it's an investor that's looking to purchase a home, doesn't matter what the down payment percentage is, the seller concession is capped at 2% of that purchase price. Now, government loans a little bit different. FHA mortgages, VA mortgage, and USDA, they have various concession amounts that do vary as well. 6% seller concession on a government loan, 4% on VA, with the possibility of even exceeding that amount to even reduce liabilities, that you could actually pay off consumer debt from the seller at closing. USDA less applicable because most areas are no longer USDA eligible in our market, but there is a way to go up to a potential seller concession, and why this makes more sense than price reduction. And I can show my screen here where in the form of buy downs, there are three versions of this, referred to as a 3-2-1 buy down, a 2-1 buy down, or a 1-0 buy down. And what that means is how low the interest rate is bought and for what buy down period. To give an example, a 3-2-1 buy down is basically taking a fixed rate mortgage or an adjustable rate mortgage, whatever the loan term is that that buyer qualifies for at that point in time. But we have the ability to lower the borrower's payments by 3% of their qualifying rate for the first 12 months of that loan.
Wow.
And the second year is reduced by 2% for the next 12 months. The third year is reduced by 1% for the preceding 12 months. And what this is really an escrow account management process where we're actually taking the concession. In this example that I highlighted is a $715,000 loan size. The buy down cost in this example is around $33,000. And this is in lieu of, let's say, a price reduction, right, off of this home, where this buyer now, from an affordability standpoint, their normal payment at a qualifying rate in the low sevens right now on a 30-year term without paying a substantial amount of closing costs to buy down that rate, hypothetically is 7.25% in this example. Their payment of principal and interest on this $715,000 loan amount would be just shy of $4,900. However, in this example, their payment's only $3,500 in the first 12 months, and we're using $1,360 offsetting on a monthly basis out of their escrow account during that initial 12-month period. Second year, it's reduced by 2%, saving them $929 for the preceding 12 months. And the third year, by $475 in this example. The great thing about this, though, is at any point during this period, the market presents an opportunity to refinance. That the remaining amount in this bucket, right, of this buy down deposit is refunded to that buyer at closing. So in essence, the buyer is really realizing that equity at closing, right? Because if you negotiate off price, whatever that potential purchase price is, you're not really realizing that equity at that point until you go dispose of that asset, right, or that liability, sell the home. Well, in this case, we're taking that seller concession and really offsetting on a monthly basis the buyer's payment to make it more affordable. The reason why this is important for a seller to know is because payment is what's moving the needle. A monthly payment is what is making that buyer feel comfortable to purchase a home or not. You know, a kind of a general rule of thumb, every 10% that we reduce purchase price is only going to lower that buyer's monthly payment around $60 to $70 for every incremental $10,000 change in price. That's not really moving the needle right now with the current mortgage rate environment. Now, one thing to point out, this is only allowed on primary homes and second homes, occupancy purchases. So this is not allowed on an investment property. Only permanent rate buy downs are allowed. But there is a cost associated to this. Doesn't matter what the FICO score is or the loan size is. The percentage factor of this is 4.6%, is what this 3-2-1 buy down, which is the most aggressive buy down strategy. But there is a 2-1 buy down. Same thing, instead of reducing that interest rate by 3% the first year and having a 36-month buy down period of a 3-2-1, this buy down period is just for 2 years. And so you actually have the first year's payments lowered by 2% in the first 12 months of payments, and then by 1% in the second 12 months. The cost is about half, only 2.3%. But this would be a phenomenal strategy to help potentially market and sell a home with a special financing incentive, such as a seller-funded buy down. But it's also important that the buyer is is aware that this is an actual option,
Yeah.
because this moves the needle greatly. And especially if you have an advisory approach on the financing side that's working alongside this buyer, that's really educating this buyer of what else they could do with this monthly savings during these buy down periods, such as paying off other consumer liability, right? A home becomes more affordable if they have less debt. That improves their monthly cash flow. So if they have the opportunity to have a substantially lower payment in year 1, 2, or 3, and they could take advantage of those savings and pay off all their credit card payments, right? Or pay off an auto or whatever the case is, it becomes more affordable outside of this buy down period.
I love it. No, I mean, it's incredible when we get into tough times. It just seems like smart people always figure out good ways to keep people in the market, finding creative ways for people to be able to buy. And I think as sellers have to start getting on board with understanding what these loan products look like, because you've got a lot of buyers that are out there, and I think you hit the nail on the head. People are glued to their monthly payment. I think interest rate is something that obviously people focus on, and it's important to them. But ultimately, when they're looking at their estimate from their lender, their eyes are going to zoom right into what that monthly payment is going to be. And so, if we have a way to get that down, at least until they might find some relief with a refinance, we're talking about huge leverage on helping a buyer get into a home, helping a seller sell a home. So this is great. I love it. So this kind of segues pretty nicely into another question, Justin. I wanted to talk. We hear so much doom and gloom out there right now, but why could a buyer or a seller still find this to be a good time to buy or sell right now?
Well, I believe it's a great time to buy. For one, just let's think of where we just were, right? Let's just, besides the data behind what I'm about to show, but if a buyer's in the market right now and sitting on the sidelines, that's taking a pause because they're concerned about affordability with the mortgage rates, right? I mean, that's pretty much what's driving the pause that we're seeing right now. But
Mhm.
look at where we were if you didn't purchase or you did purchase in the last few years. Let's just kind of rehash what every buyer experienced during this time frame, right? They experienced a lot of loss. And what I mean by that is a lot of competitiveness out there in the marketplace, multiple offers, right? That paying significantly higher of a list price to potentially have your offer accepted, the ability to not have contingency contracts accepted, right? Meaning if you have a home to sell before you're purchasing the next home, that was not a negotiable item in the last few years. You have basically no opportunity to negotiate in a contract right now. Sometimes, buyers were being pressed to put offers on properties that may be sight unseen. There was a lot of chaos ultimately in the last pandemic era of real estate. Now, it did ultimately, from the seller side during this whole time period, it has driven our appreciation of prices up quite a bit, right? So even though on the seller side right now, you may not be having the multiple offers on your property, and yes, you may have a little bit of negotiation on the buyer's behalf for these listings. Well, look where you just came up on the run up from an appreciation standpoint in these last several years to take advantage of a lot of equity that you may have earned and gained over this time period. So current market, kind of the opposite, right? Positives would be from the buyer side, you have a lot of negotiation to take advantage of right now, comparatively, because you have less competition out there. You're not having to, pay all cash for a property. You get to leverage, maybe put less down, leverage your asset. Lower down payment can get accepted, no problem. Contingency contracts. You have a house to sell, or maybe you have to get a lease on your existing home if you don't plan to sell that home to buy another property. Those are becoming more commonplace. The ability to not have to waive appraisals, right? To have a full appraisal waiver. Those are all positive aspects as a buyer right now to take advantage of the current market. Seller side, again, you have a lot of opportunity to take advantage of the run up on appreciation right now. There has to be some type of correction at some point and we're just having this little correction right now. But the slides I'm sharing right now, I did want to kind of hash out of why it really is a great time to buy and some of the fundamentals that's happened in our marketplace that is a precursor to what to expect. Some of the arguments right now would be the inverted yield curve right now from the 2-year and the 10-year that triggers a recession. Statistically, that also is a precursor of lower rates to come. The inventory, that's really a national severe problem of undersupply of housing in the U.S. that we have right now. Some demographic forced demand. I can show you what that means by the typical buyer being a 34-year-old millennial buyer is the number one buyer right now, and look at population growth of the current 33, 32, and 31-year-olds that will become the largest buying profile in years to come, as well as the fundamentals of homeownership haven't changed and why this winter really creates a great opportunity to purchase. The slide I'm showing right now for anyone listening right now is really a history of the 30-year mortgage rate. So you can see on this right-hand chart where we're at right now, just hovering above 7% for everyone listening. You can basically see where we've been. This goes back to before 70s of mortgage rates, right? So we kind of forget where we've been unless we see something like this before, or you haven't been a purchaser or a seller in the market previous to the last decade or decade and a half. We've, this run up from the housing crisis, or I should say run down in mortgage rates, is the abnormal time. That we've been in abnormal times historically for mortgage rates. So statistically speaking, we're below average right now, even though I still believe that we're gonna go lower at some point. This is an origination forecast from the Mortgage Bankers Association that really just shows where we've been, but also from the real estate side is important to see where purchase transactions are predicted. So this blue graph that you can see if you're viewing here is ultimately purchase originations, meaning no refinances. Buyers that are out there purchasing homes and real estate through financing through mortgages. So you can see where it's projected to be right here, and this is in the billions nationally. But we have a little bit of a drop off expected, this from this year to next year. But look at what's projected in 2024 and 2023. It goes from 1,586 up to 1,783 billion, where the expected purchase demand is going to increase over the next several years to come, which is going to be a strong demand in housing in the forecasting. A lot of headlines out there. I would probably advise listening to CNBC just because they get it wrong significantly. Of a lot of doom and gloom and a lot of fear is ultimately the purchase. But a lot of market insiders are predicting that the mortgage rates will fall by end of next year in 2023. The Mortgage Bankers Association predicts that average rates to be in the mid fives, around 5.4 is what they're projecting. So this is a graph right now of the historic chart of the Fed funds rate from 1955 to present of what happens when the Fed increases the Fed funds rate. So anybody that's listening right now, the chart basically is showing anytime the Federal Reserve increases the Fed funds rate is followed by an economic recession, which is in the gray chart. You can go back every economic recession since the 50s. What has happened to the Fed funds rate? They've reduced it. So at this point, if technically we from a GDP standpoint, we're in a recession, even though it may be a mild one, and how long it's going to last. But the Fed funds rate ultimately reduces in economic recession periods, which mortgage rates should reduce. The reason why, mortgage rates are a little bit higher right now has to do with the demand because of the run up in rates with the economic policy of the Fed funds increasing the rates, most aggressively in history right now, has created a reduced demand in mortgage-backed securities, which is basically loans sold in the secondary market. That the demand is low because the investor market and the secondary market believes that they're not going to perform, meaning they're all going to early pay off in a lower rate environment and refinances. So that's a great thing to hear as a consumer, because the anticipation of lower rates on the horizon is what's actually expected. So, and this is something I wanted to show that really is important to show both on the seller side and the buyer side. This is the median sales price in the US of housing. And you can also see what happens in the gray shaded areas in recessionary periods, even though there may be periods during that economic recession. But look at the trend of still what happens in home prices, even during economic recessions. Home prices continue to go up. And so this chart in the long run, if that's kind of what we're looking at, real estate's a phenomenal investment, right? I mean, I don't think we're arguing on this or having a disagreement on this call that it's not a great investment, but we have to look at the trend. And if you're sitting on the sidelines thinking about buying a home or not purchasing a home, there's going to be a lot of opportunity missed, right? I mean, use this example right now with an employer retirement plan. I would say most employees have an employer-sponsored retirement plan, a 401k. If you're self-employed, you probably have a SEP IRA. How do you invest in that retirement plan? Do you just try to wait until you think it's going to hit the bottom before putting all your contribution dollars into that account? No, you stay methodical, you invest in the long run, and ultimately that plan's for retirement. Same thing with real estate. There's no better way to show than this graph right here of what household prices do in the U.S. in the long run, and even during economic recessions, except the housing crisis, right? That's a different type of recession. It's housing related.
Man, Justin, I love it when a guest comes prepared. This is incredible. It's hard to believe we're already coming up on 30 minutes. I want to remind everybody, feel free to chime in. You guys can chat in if you have any questions for myself or Justin. We're going to carve out a little bit of time for Q&A at the end. I mean, this is awesome data. I mean, and I think what people need to learn to understand is you can't trust the buzzy headlines. It's clickbait. They're trying to get you to click on it. Bad news sells right now, unfortunately. And a lot of the news that you're going to see is just flat out scary. And it's not to say there isn't things to be concerned about right now, or there's not things to consider, but you have to educate yourself. You have to look at data. You need to look at trends. You need to look at things like this. And for me, a lot of the reasons why I still talk to buyers right now, and why I do feel strongly that and under the right circumstances, it's absolutely a good time to buy right now, is because we have so many people that are just sitting on the sidelines. We know we have all this pent-up demand. We know we have all these buyers that either got priced out before or just lost over and over and over and over in multiple offer situations. And now is their opportunity to get into the market. And what they have to remember is all of this pent-up demand, once we start to get some good news and we start to see rates start to fall, and we start to see a little bit of inventory out there, and we start to see headlines that are looking a little bit rosier, and we start to get consumer confidence starts to go up, there's so much pent-up demand that it could easily see you winding up in the same spot, to where you end up, if you wait too long, you're in multiple offer situations again. You're in a spot where it's getting a little bit harder. So right now, I'm looking at it like, we have a lot of homes out there that are sitting on the market because we have buyers that are just waiting on those rates to fall or waiting on good news. Well, right now you can negotiate with a lot of these sellers that, sellers right now that a lot of times are listing their houses. They're doing that because they need to sell. They're getting relocated. There's some life event that's causing them to want to sell, or maybe they're looking at this as their opportunity to get a great deal on their, forever home, or they find it's a good time to buy, so they want to trade up. But anyway, you have a lot of sellers right now that have tons of equity. And that's a huge difference now compared to 2008. In 2008, depending on where you were in the country, we had 6 to 9 months supply of inventory on homes that had very little to no equity, because we had 100% financing and they were rolling in closing costs. So people were financing 103, 105% of their home. So when they went to go sell it, there's no margin for error. There's no room to decline in value. Now you have people that have been sitting on a mountain of cash in their home, and guess what? They can negotiate with you. And if they see the right upside on their next investment, they're going to be willing to trade a little short-term equity for maybe a long-term deal. So right now is an amazing time for a buyer to go find a smoking deal, educate yourself on some really good loan products that are out there to get you where you want it and need to be right now when it comes to your monthly payment and your household expenses. And then look for your opportunity when rates do fall into the low to mid fives refinance and put yourself in a better position long term. But what always ends up happening is everybody is trying to time the market. If we could time the market, we would all be billionaires, right? So unfortunately, what ends up happening a lot of times is a lot of people waited too long to sell, and a lot of people are going to wait too long to buy. And they're just going to end up in that same repeating pattern where they're trying to time it and they're overthinking it, and it becomes paralysis by analysis. So I think people need to understand, if you're in a position right now to where you can buy, the market is not going to be in this huge long-term recession forever. Even if your home dips in value, if you're in that home long enough, you're going to come out the other side and you're going to be just fine. I mean, look at anybody who bought a house in 2007. If they held on to that house for at least 3 to 5 years, they probably came out the other side just fine. And they were able to withstand some short-term turbulence as long as they were able to hold on to that house long enough. And I mean, for investors right now, you obviously want to be very cognizant of your purchase. You're going to make all of your money on your purchase. But now you have sellers that have a lot of equity. They're able to drop their price. They're able to negotiate. And if you can get in and get out at the right time and do the right upgrades, there's still pent-up demand. There's still buyers out there. So, man, Justin, this was awesome. I'm gonna give a few minutes if anybody wants to chime in with any questions. While we're doing that, I want to make sure I give you the opportunity. If anybody wants to get a hold of you to talk about this stuff, what's the best way to reach you, and kind of just talk shop about different lending options?
Yeah, no, appreciate it. Best way is I always put my cell out there, but 512-665-8353. That's my cell phone, 512-665-8353. My email is justinh@cmgfi.com. So that's Justin H, Charlie, Mary, George, Foxtrot, Indigo.com, or loanswithjustin.com as well. So, but I'm here local in Central Texas. CMG Financial, like I mentioned, we are a privately held mortgage company. We actually originate the most loans by loan volume the last 3 years in a row out of any residential mortgage bank here in Central Texas. We have a lot of patented tools. Your investor listening audience right now really needs to be aware of our patented all-in-one loan. We have a opportunity with a first lien position line of credit. I know we've been talking about mortgages. This is a little bit different because it's not a mortgage, but we have a first lien position line of credit that we allow for investment properties, purchase or refinance, second homes, and also on Texas homesteads. So that's a great way to finance in this current market, really become a privatized bank where it comes linked with the zero balance sweep checking account. We can have a whole separate podcast on that program, but the all-in-one loan is a phenomenal financing tool that definitely all your listeners need to be aware of, and especially the investment community, to be able to actually purchase a property or refinance with a line of credit. And that includes investment properties. And we have a lot of great ways to finance or qualify borrowers from asset depletion on this property, or double the amount of agency loans, meaning Fannie and Freddie cap investors at 10 finance properties. We'll go up to 20 on this type solution. So it's a great way to hedge on interest expense, but ultimately become a private bank with your home as collateral through the line of credit and sweep account linked to it.
Love it. So we're definitely going to have to have a part 2 with Justin. So we were talking before we jumped in. You've got a lot to talk about when it comes to Airbnb and Airbnb financing as well. So anybody who's out there looking to get into the Airbnb space, Justin's an absolute pro. You've got your own properties that you own and manage. You obviously specialize in financing on that front as well. So anybody out there that's either in or looking to get into the Airbnb space, Justin's got some killer products as well. So definitely reach out to Justin. You can find him online. Justin and I have known and worked together for many years, so I can certainly vouch that he's one of the best lenders in town. And I really appreciate you coming on. If anybody thinks of any questions that they weren't able to chime in with, feel free to reach out to Justin or myself anytime. And we will certainly get Justin back on to talk about some different loan options, some other exciting products in the Airbnb or short-term rental space. And he's got a lot of other stuff to talk about as well. So it's hard to capture that in 30 to 40 minutes. So appreciate having you on, Justin. And thank you guys, everybody, for tuning in. Again, this was episode 7 of Real Estate Real Fast. We do these on Wednesdays. We typically go live around 1 o'clock. We do have a pretty good catalog of shows already, so feel free to check out. You can find us on Apple Podcasts, Spotify, and we really appreciate you tuning in and supporting us, and we're excited to bring you some more content here in the near future. So thanks, everybody, and take care.